What if I told you your debt could be saving you thousands of dollars? Wealthy people love debt, and after this video, you will too, because I am going to educate you on what debt really is, how you can start using it to minimize your tax liability, and ultimately save your business money. And if you watch this video in its entirety, I am going to make sure that my business owners know when is the appropriate time to bring on debt in your business. But before we jump in, I don't want you to forget to like, comment, and subscribe so you don't miss out on any game-changing information. Now, let's get after it. What is debt? Debt is literally where you owe money to somebody else. You're in debt. Debt could be you have credit card debt. Debt could be you have a loan on your vehicle. Debt literally just means that you owe others. And all debt does not have to be connected to something that's physical or tangible, right? So just remember, debt is when you owe people money. I want to give you two definitions of bad debt. Bad debt, when you are a business owner, means that you have paid for something that really isn't going to help you get further in your business. So for example, you just are putting a bunch of stuff on credit cards, useless things, and it's nothing tangible that is going to help you move your business further faster. And it's bad because you owe it to the bank, to your creditor, and it didn't help you get to where you needed to go. But also in business, bad debt is where people owe you money and you're not going to be able to collect. So when you are a business owner and you are allowing for your merchandise to go out the door and people to have payment terms with you, or you're providing people a service and they're paying you after the fact and you know you're not going to get paid, that's considered bad debt, meaning you're sitting on receivables, people owe you money, except for you're not going to get paid for the money that they owe you. What is good debt? That means I am actually going to owe somebody else because I need to purchase something in my business that is going to help me get to where I need to go. So for example, I upgraded my computer system. I purchased new computers. I purchased new equipment. My team is now able to move through what they need to do faster. That's good debt because that purchase gave me equipment. That equipment has a value. I could turn around and sell that equipment and make money off of it. And that equipment also is helping me get to my end game faster. Let's say that you are an online reseller and you need to stock up on your inventory prior to the holidays, and you need to go purchase from your supplier, but you don't have that money in your bank account. Does it make sense to put that purchase on a credit card or to use some of your working capital where you're now going to owe the bank back? Absolutely it does, because you need to get that inventory for your business, and you know come the holiday you're going to sell. So don't necessarily be afraid of going into good debt. Just want to make sure you understand that good debt is debt that is going to help you get to your goals sooner. Good debt is debt that is going to allow your business to make money faster. Good debt is going to allow you to purchase equipment so that you can move quicker. Good debt is going to allow you to get the inventory you need to sell getting ready for the holidays. That's good debt. Now, I want to explain to you how wealthy people use good debt. Good debt is also when you leverage the ability to utilize debt to get you something that is going to help you along the way. One great example of that is the purchase of real estate. When you are purchasing real estate, and let's say, for example, a piece of real estate costs us $300,000. Most of us do not have $300,000 that we're just going to pull out of our bank account and go, here you go, bank. Here's $300,000 for me to purchase that house. Absolutely not. What we're going to do is we may put 5% down, 10% down, a small amount down as a down payment, and then we're going to go into debt and leverage that property for the amount of the loan. So when we talk about leverage, that means that I own an asset the real estate. I'm going to say to the bank, lend me money against that asset. So I'm leveraging that asset, and that's good debt. Why is it good debt? It's linked to an asset. It's linked to an asset that is worth something. You could turn around and sell that real estate. Therefore, wealthy people always leverage debt. They use what we call OPM. Other people's money. That's right. Very rarely are you going to have a wealthy person come out of their pocket and be like, here you go. Absolutely not. They're going to show up and talk to their bankers. That's why they have bankers. That's why they have that superior service. If you ever walk into a bank, I want you to check it out. Average people get in the bank line, but the wealthy people get over here in the line. The person looks up and they see them. Then they come open the door and they let them behind the counter. That's because they're talking to their banker. They're talking to their money manager about how they can leverage good debt. And here's the thing. When you leverage good debt, it's typically tied to the tax code, so you can get a write-off. That's right. So when you think about mortgage interest, for example, on a piece of rental property, you're able to go buy that rental property. It costs you $300,000. And guess what? The code section says that you can take a write-off of that rental property by using code section 169, that tax depreciation, code section 167, tax depreciation, code section 179, accelerated depreciation. You're able to leverage that and get a big tax write-off. So now let's back up. We bought a house that was $300,000. We used OPM, other people's money. We put very little of our money into that transaction, and we now have some debt, but it's good debt. But now we're going to come back and we're going to take a write-off on that house and lower our taxes. And no, you're not going to be able to write the whole thing off. You're going to follow the code. But if you use the code properly and use tax strategies properly, you'll be able to write a good 75% of it off, maybe in year one. Or you're going to be able to write it off over time. But this is where wealthy people leverage debt, and they get write-offs, and they never pay any income taxes because they use good debt. They use the tax code. They use the mindset of a wealthy person. They use OPM. And that's what I want you to start doing. I want you to understand how to use OPM, other people's money. And when you are a business owner, when is it time for you to go into debt? When you have a good business plan and you know you're going to need some working capital to get you to where you need to go. So you're going to go into debt when you need to fill up your inventory prior to a holiday, or you need to get new computer systems for your team, or you're ready to hire because you know your business plan is in place and you need to get in your infrastructure to make certain that you can take your business to where it needs to go. That's when it's time for you as a business owner to take on debt. Many of you are taking on debt at the wrong time in your business. I can tell you, I started my business on a shoestring, and I did not take on any debt in my business until I knew my business had a sustainable revenue model and I could go next, and it was time to grow and go and put more cash in my pocket. So business owners, don't be afraid of debt. Take on good debt, leverage the appropriate type of debt, invest in your business at the right time. And when you do, you will see your business grow and you will be able to put more cash in your pocket. And that is why when you know better, you have to do better. That is why I want you to like, I want you to comment, and I want you to subscribe so I can keep you updated on all things business and tax.